Okay, so Conagra Brands just dropped their earnings, and honestly, the stock's reaction was interesting. Let's dig into what actually went down in their first quarter for fiscal 26. And bam, right out of the gate, the market spoke loud and clear. The stock jumped up over 5% on earnings day. I mean, that's a pretty serious pop from investors. But here's the thing, right? If you just glance at the main year-over-year numbers, you'd be scratching your head. They don't really scream 5% rally. So what gives? What did Wall Street see that got them so fired up? All right, so let's talk about the big picture here. This was a classic case of beating a super low bar. You've got to remember, this stock has been absolutely crushed, okay? Down over 40% in the last year. Expectations were, well, they were on the floor. And that's the key. Conagra came in and delivered against those low expectations. They beat on the bottom line, 39 cents versus the 33 cents everyone was expecting. And they nudged past revenue estimates too. It wasn't a huge beat, but in this kind of environment where investors are desperate for any good news, it was more than enough to light a fire. Okay, so that's the beat, but now we gotta peel back the onion a bit. Let's look at how these numbers stack up against last year, because this is where the story gets a lot more complicated, and you see the real challenges. First off, total revenue, down almost 6% from the same time last year. That's a pretty significant drop on the top line. And it gets worse when you look at earnings. Adjusted EPS, that fell off a cliff, down over 26%. Oof, that just shows you the kind of intense pressure they're under when it comes to actually making a profit. And where does that pressure show up? Right here, in the margins. They got squeezed big time. We're talking a contraction of 244 basis points. For those of you keeping score at home, that's almost 2.5 percentage points wiped off their margins compared to last year. This chart really tells the whole story, doesn't it? Organic sales were only down a little bit, which sounds okay on the surface, but look how they got there. They raised prices, which helped, but the actual volume, the amount of product they sold, went down by 1.2%. And that is the core problem they're wrestling with. So if the year-over-year picture looks so rough, let's circle back to that big question. Why on earth did the stock rally? Well, it wasn't about the past. It was all about what management is doing now and what they said about the future. Okay, this was huge. The #1 win of the quarter, hands down. Management confirmed they fixed their supply chain mess. Service levels are back to 98%. This was a massive, massive problem last year. So telling the market we can actually get our products on the shelves again, that is a game changer. The CEO, Sean Connolly, also laid out a really smart game plan. He called it a horses for courses approach. What's that mean? Simple. For their star players, like frozen foods and snacks, they're spending money to get people buying more again. But for their everyday staples, they're being tactical with pricing to just bring in the cash. It's a really practical, two-pronged attack for a tough environment. And you know what else investors love? Honesty. Management didn't sugarcoat the cost situation at all. They came right out and said, look, we're building at about 4% for core inflation and another painful 3% hit from tariffs. That's a total headwind of around 7%. That kind of transparency goes a long way. But they didn't just stop at, here are the problems. Nope, they followed up with a clear 5-step plan to get those margins back. This wasn't just fluff, it was a real roadmap, and it showed Wall Street that they have a credible plan to get profitability heading in the right direction again. All right, so let's put on our analyst hats. What does all this mean for the stock from here on out? Let's break it down into the good and the bad, the bull case versus the bear case for Conagra. On one hand, you've got the bulls. They're saying, hey, the execution is getting better, they fixed the supply chain, and the guidance they gave us feels solid. Plus, with the stock beaten down so much, maybe it's just time for it to bounce back. But then you've got the bears, and they're pointing to that nasty 7% cost inflation and saying the consumer is still weak. They see those negative volumes and think demand just isn't there yet. So, weighing both sides, where do we land? For us, the rating on Conagra is market perform. And here's why. We're really encouraged by the operational turnaround. That's a big checkmark. And their guidance kind of puts a safety net under the stock, which limits the downside. But, and this is a big but, those headwinds from inflation and the broader economy are just too strong to get super bullish. It feels like they're steering the ship well in a storm, but they're not ready to hit full speed ahead just yet. Okay, now for my favorite part, the trade idea. It's a little out there, but hear me out. We're thinking a pair trade. You go long on Conagra, but at the same time, you short the consumer staples ETF. That's the XLP. So what's the logic? Basically, you're betting on the company, not the entire sector. The idea is that Conagra's internal fixes, their self-help story, will help them do better than their competitors, even if the whole consumer staples space is struggling with inflation and nervous shoppers. It's a bet on company-specific execution. So as we look ahead, here's the billion-dollar question. Can Conagra's hero businesses, that's what the CEO calls them, their frozen and snacks divisions, can they actually get their mojo back? Can they start growing again and pull the whole company back to balanced growth next year? That right there is the ultimate test of this turnaround. And as always, gotta say it, this is not financial advice. Please do your own homework before making any investment decisions.